Welcome to the Commercial Real Estate Show. I'm Michael Bull. Thanks for being with us. We are your source for market intelligence, forecasts, and strategies. We have a great show for you today. We have real estate forecast from Ernst & Young, or you might know him as EY. In the Studio One here, we have Tom Brown. He's a partnered real estate hospitality practice and real estate practice based here in Atlanta. Tom, thanks for joining us. We also have Mark Grinis. He's the real estate practice equity leader, and Mark's here in Studio One. Thanks for joining us. Well, gentlemen, let's start off with, I think, a question that all my listeners and viewers are kind of concerned about is where are we, in the cycle? It seems like this cycle's been a little bit long in the tooth, and some people are a little concerned. Where are we?
It's I kind of have spent my career riding cycles. Traditionally, I grew up in the early 80s in the Houston real estate cycle. I went to California through the savings and loan cycle. I went to Tokyo to go through the Asian economic cycle.
You're really beat up.
Well, when I came to New York, I think everybody hid underneath their desks. But so when you think about we're so conditioned to think about, if we're in year 6 or year 7, clearly we're getting long in the tooth and the cycle is about to come. And I think any of those kind of generalizations, although they generally have some continuity, history isn't the same. It kind of rhymes, it's similar, their attributes are the same. But this one's different for a lot of reasons. And this real estate cycle is different because our business cycle is different. We've been in a slow growth environment. We have not been at what we're used to is after a recession, boom, our economic activity picks up by 4 or 5%. Real estate immediately surges and tries to catch up. Real estate's trying to balance that supply and demand dynamic. We typically get over our skis and boom, here we go again. It hasn't been that way. And so I think those that look at the cycle and say, we're about there. We might be there from a price perspective because of the very unique fact patterns of interest rates and what the Fed's role has been in the marketplace, but I think less so from a business perspective.
Because it's been a real healthy growth, right? If you think about the slow growth, it's created some health in the market, right? Because of the lack of new supply and the lack of exuberance, right, to go out and overbuild.
That's right. I think that the way the market has come back, it's allowed people to be disciplined. You don't see a lot of overbuilding. Obviously, there's been a lot of residential, but if you look at the historical past, there was a real slow period before in multifamily residential. So there was a need for some growth there. And a lot of developers, a lot of investors have really been cautious about how they underwrite projects, and they've really been able to keep their growth in check and not really just go out there and start building and hoping that people will come.
I think you also, if you look at NACREIF or you look at some of the benchmark index, typically before you hit a period of negative growth, it's typically been double digits. It hasn't been 6 or 7 years. It's been from a period, from a peak to trough, it's longer than that. So I just caution from a oversupply kind of dynamic, that traditional cycle. It might be more of a price adjustment for interest rates, but less of a huge overhang that creates a fall into a cycle.
Well, let's talk about pricing a little bit. You mentioned something I think our listeners are interested in is the talk about bubble. There's talk about some of these prices are higher than they've ever been, especially with office properties and some industrial properties, some multifamily properties, especially in some of the gateway markets. So what do you say to people who are concerned about maybe bubble pricing?
I would say bubble pricing has been driven by a Federal Reserve that drove down interest rates and has created capital to flood to many asset classes, which has included real estate. And real estate's, quite frankly, been incredibly attractive at the yield spread of what you can get on real estate versus U.S. Treasury or pick your other a bucket of assets. So real estate in that regard is very attractive, but it's been one of many asset classes that has enjoyed the flood of capital that's driven down yields. When it reverses, that kind of means all asset classes will reverse. So, it's not, again, even this one's different because we're coming off a Federal Reserve and how it impacts real estate, which has been a little bit different than previous cycles. So,
yeah, I think Mark,
you hit it.
like that, yeah.
So you talk about bubble pricing. So are you not concerned that prices are in a bubble, or you think they are, or are they not in a bubble because the fundamentals are still so strong?
Yeah, that's a good point. Yeah. I think that when you look at what the future state of real estate, and you really clip them down into the different markets, you got office, you got retail, multifamily, the fundamentals continue to be positive. You're still seeing rent growth. And even though in the office market you've got differing uses for office, a lot of uses for how companies are using office, you're still seeing a increase in rent rates, high demand, and that's creating good NOI growth. Hospitality is the same. It's been benefiting from some great market economics, and occupancies are still up, so the demand is still there. So when you look forward and you think about all the fundamentals, I think that there's still some runway there, and I don't think we're in a bubble. And the other piece you see is some of those real low cap rates, some of the real low yields in the big central business districts. As those properties become more expensive, you do see capital starting to look elsewhere into the secondary markets, looking at some of the larger cities in the southeast, for instance, or southwest, and they've been benefiting from that pricing.
I mean, real estate is 10% of the economy, and so when you talk about bubble, you have to say, what is that other 9/10 doing, and what is the situation of that 9/10? And will that create a situation where we, the suppliers of the sticks and bricks in which that 9/10 conducts its business, which direction is it going? This has been the worst recovery ever, and so we have chugged along at a very slow growth. So to think that, wow, we're on the precipice of, because we've just so overshot that we're going to fall, that this other 9/10 is going to fall off the cliff, I don't see that. Again, prices are rich. Mm-hmm. Those that occupy and use the real estate have been growing at 2%. I see us growing another 2% next year. Is it gangbusters? Are there markets that might be overbuilt? Yeah, sure. Are there markets where e-commerce and other, distribution have great growth opportunities? Absolutely. So, a little bit risky generalizing, but I just don't see the precipice.
Well, that's a good point. If you're having good job growth, you're going to have good demand for commercial real estate, right? Well, what about the impact of rising rates? Everyone expects rates to rise. Everyone knows exactly how much or when. Maybe you could tell us today, right?
Sure.
And the impact on commercial real estate.
Well, we actually did publish a paper, kind of a view and a forecast on interest rates. It's a global world, and central banks from around the world are easing and flooding markets with capital. That has clearly a downward pressure on interest rates. We are pretty much the only market that's really trying to rise interest rates and is fighting upstream against countries like China and Europe and other countries that are easing. So there's a lot of global forces, and it is without question a global currency market that has implications to our interest rates. And capital flight to the U.S. we are still clearly the destination of capital. So as capital moves in, what did we just see right now, just recently when the Shanghai sold off? Yields on the 10-year dropped. We will continue to be a safe haven. We will continue to be an attractive place that holds interest rates in check. we don't see interest rates. I don't see, speaking on myself, I don't see interest rates rising that quickly. Maybe a couple rate hikes this year, that's it.
Well, if we get a couple rate hikes, then you think because demand is so strong from investors, that's not really going to impact the values of commercial real estate then significantly.
They're too small. The rate hikes are too small.
Yeah,
Yeah.
I would agree. I think that the risk is that interest rates go up too quickly. That might create a risk.
Yeah.
But with a slow increase and just a few increases in the year, I don't see that having a significant effect on the way things get priced. And I think that low interest rate's been priced in a lot of debt pricing as well.
Okay. All right, we're going to take a short break. We'll be back with more on the Global Market Outlook 2016 from EY. Stay with us. The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL. Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Thanks for being with us. Today we have a treat for you. We have EY here. We have Tom Brown and Mark Grinis from Ernst & Young. We're talking about their global market outlook for 2016. And one of the things that I think are a concern to some investors and occupier space out there is new supply. I mean, I think some occupiers are getting rate shock in a lot of the cities, including the city where we're sitting today, where tenants are renewing leases and the rents are 20% higher than they saw when they did their last lease. So where are we on new supply, and how is that impacting the commercial real estate industry moving forward?
I mean, I guess there's two ways to look at it. One is kind of a running average of what new supply is, on a 5-year basis, some kind of historical benchmark against previous building cycles. And we're, except for apartments, we're pretty much below that. So again, why is that? You can say, well, we're not building as much and we're more disciplined. I'd probably argue it has more to do with we're growing slowly, demand is being a little bit more measured, and new supply is being provided in a little bit more measure. There clearly are markets that are hot, make no mistake. There's clearly lots of cranes in many, many different places. But a lot of the places where a lot of the cranes are taking place are, in fact, the places where the strength of job growth is.
There is demand.
There is demand. Yeah. So, are there places that are over their skis? Certainly, but there are also markets that have good job growth, and the supply is there for it.
So what does that mean for tenants? If you're running a business, should you expect rental rates to continue to increase and the market get tighter when you look for a new space?
There is a limit to how many people are going to sustain those significant rate hikes, and you are going to be driving people into secondary locations, B locations. You will eventually run out of those that pay the super premium prices, and you'll have that push that'll send others out into other locations that are more affordable.
And does that have an impact on the investment property values? I mean, if they're building less supply and we have all this money pouring in from everywhere, it seems, for commercial real estate, is that one of the reasons that might keep cap rates low and values high? How is the lack of new supply enter into that factor?
Yeah, definitely, because the pricing is based on what the demand is for the space, how you can drive your rents, and so long as the supply is in the right spot, people are keeping the supply in check, that's going to keep the pricing up. Your cap rates will be down, but you'll also see a drive up in NOI. So you may see, again, with interest rates going up slightly, you may see a little bit of expansion in cap rates, but you're going to continue to see NOI growth, and I think that'll sustain the values. So long as we keep all that in check, I think that's going to keep the pricing in check. I think the one sub-market that probably is growing faster than its historical is in industrial and logistics, as e-commerce continues and products continue to need to be housed in warehouses and shipped off to people. I think that's the one place we're going to see growth that's probably faster than historical, because there's a demand there.
I guess we focus in on the supply and demand dynamic, but probably just as important in every single asset class, there's usually some form of disruption that's taking place. We all know about e-commerce. It is absolutely growing rapidly. It isn't hollowing out all retail, but it's hollowing out some retail, and there certainly have been sacrifices. In office, the office of the future, where the old rule of thumb of 250 square foot per employee, we're doing some of our buildings 80 and 100 square feet per employee. If it truly was a same store basis, you'd need half as much real estate. So there's clearly impacts of office of the future. The multifamily dynamic, of coming off of moving into city centers, I think we are at some point to pivot back to residential, not an abandonment, but residential will reemerge. It has been relatively silent, to some degree. So I think just as important as looking at the supply and demand is really the fundamentals underlying, and what is this e-commerce type world doing to each particular property type.
Yeah, those are good points. And one of the demand features for valuation is the flow of money, right? Like the foreign investors that are moving to the U.S. Even more so in 2015 than they did in 2014. What do you guys see moving forward? Are we still going to see this real flow of capital into the U.S.?
Well, living in New York, where condominiums that 5 years ago were $1.5 million or $7 million. I mean, there is an absolute staggering amount of foreign capital, certainly going to some of the key city centers. There's also another element of foreign capital that's going into funds, as major sovereigns and major foreign pension funds, and we can talk a little about FIRPTA and tax as well. There are factors that are driving capital into U.S. real estate, and I really don't see that abating too much. There are oil slowing, will have some impact on Middle Eastern sovereign wealths. China slowing will have some impact on Chinese construction companies. Doesn't fall off the cliff, but it does create some reduction. So I think there's a little bit of ebbs and flows in that.
Yeah, and you talked about FIRPTA. So there's the recent changes were just in December, and it seems like there's already a little bit of an uptick of foreign investment in U.S. What do you think is going to happen there?
Yeah, I think it's one of the few places where we see a new rule that is positive for investment. And here there was a little bit of relaxing as to how much foreign investors can own of domestic REITs. And I think we will continue to start seeing that as that money is available. And then, as you know, a lot of REITs are currently trading at a discount to their net asset value, which makes them a pretty good buy. So I think we'll continue to see that capital come in.
I mean, if you're a foreign pension and before December 18th, you said you were limited to 10%, could go into, whether a REIT or commercial real estate. And suddenly on the 19th, the rule is, you're not subject to FIRPTA. So, that clearly is a channel that allows more optionality for that foreign pension fund to decide, I do want to own 100% of this, or I'd like to take a 51% interest in this joint venture. There are combinations that I can see of pension funds that simply is a net positive. It's hard to see, is it a flood of capital? Is the fact that it was 10%, did that really limit the allocation of how much money that they said we're going to put into the U.S.? Maybe, maybe not. But I think anything that's a positive will absolutely increase to some degree capital into the U.S.
Well, with all this demand increasing, and we're short on the break here, but is 2016 the time to sell? I mean, we saw record volumes of transactions in 2015. Is 2016 even better for sellers?
I guess if you stare down in a rising interest rate and clearly prices are heady and you can just, want to sit out for 3 or 4 years, I guess maybe there could be a case to be built. I still think you're going to be generating positive yields, favorable yields. The yield spread's not going to change. There might be some pricing pressure, but there's going to be pricing pressure on every asset class as interest rates rise.
Yeah, well, that's a good point. I think if you are thinking you might want to sell in the next 4 or 5 years, timing surely looks good to do it now. Well, stay tuned. We'll have more on the future of real estate according to EY. I'm Michael Bull. This is the Commercial Real Estate Show. Stay with us. Xceligent, the resource professionals like CCIMs, CBRE, JLL, Colliers, and Bull Realty use for market intelligence. Commercial Search is the site to market and find available properties to buy, sell, or lease all over the country. Visit commercialsearch.com. Welcome back to the Commercial Real Estate Show. I'm Michael Bull, where we're talking with EY about their outlook on commercial real estate. We have Mark Grinis here with us and Tom Brown in Studio One. And in the previous segment, you mentioned the price of oil and how it's impacting investors into U.S. from sovereign funds and things. But let's look at it on the U.S. side. It seems like all my friends have more money. Even my son, he says, "Dad, it costs half as much to fill up my Jeep now. This is fantastic." Is there an impact there on our economy and commercial real estate?
It's a massive tax cut. Effectively, it's disposable income, and I think, as I mentioned before, 9/10 of the economy uses our real estate products. So what happens when, and we're 70%, 67, 70% is consumption. What happens to consumption when you've just had a major tax cut and when you fill up your gas tank, you have $50 more than you thought you were going to have? We're in the Southeast, so I'm assuming an SUV, just for that example.
Well, the Budweiser prices go up.
But let's face it, that's a massive tax cut that produces disposable income. Clearly, the headline has been how it's hurted the index and the stock market because oil and oil futures and all that's driving trades. But look out behind you. Consumption's coming up behind it, and that's the offset. And I think it's going to be a very favorable one.
Yeah, I think it's going to take a little time to run through the economy. If you look at so far, we haven't seen this huge increase in consumer spending, although that the money is there to start doing it. Although I think if you look at a lot of the restaurants, I know restaurants have been doing extremely well. People decided to take all that extra money and go out to dinner, I guess.
Yeah.
But I think that it's going to be, people are going to start saying, "Hey, I do have extra money. I've put a little bit away now. I've worried about my savings. Now I'm going to go out and spend it."
And the fundamentals are there. You said moving forward for real estate to do well. What about the job market? Is your outlook that job growth is going to increase or stay stable, and how might that impact real estate?
I think one thing that's been missing from this recovery, and almost every recovery that we've gone through after a financial crisis, the number one leader is housing. It's typically pulled us out. Now, obviously, housing pulled us in, so it was the last one out. But we have been so far under peak housing construction that cylinder, if you will, from an 8-cylinder engine is missing. I think that cylinder is picking up, and not to say that it'll get back to the peak output of 2 million, but it certainly is rising. And there is so much. As soon as you buy a house, you buy furniture, there's all the upstream and downstream effects of housing, and I really see that being as an important addition and I don't know if it'll light the afterburners, but it certainly is going to stimulate. It'll continue strong job growth.
And should housing continue to improve then? Do you see the residential market continuing to grow and do well?
Yeah, I think we've been doubling up. We've been, consolidating, living at home and in the basement, and all your kids are hanging out with you longer than you thought. They're 40. It's probably time for you to get out. So that kind of creates a pent-up demand, a hidden demand equation, and you're 40 and it's probably it's getting a little late. If you're gonna have a family, it's probably time to get on it. The burbs are starting to look attractive. I think that is an element out there.
Yeah, I think you're absolutely right. I think there's just been a shift. The millennials, which is a big generation, it's bigger than the baby boomers, they're starting to get to that age where they do need to get out and start their own households. And I think you've got this natural progression. They're first going to go to an apartment, live close to the city, do the work-life balance in the city, and then inevitably they'll start to move back out as they start to think about having children and what schools their kids are going to go to, and the pendulum will swing that way a little bit.
Well, it's interesting you bring that up, because that seems to be one of the things that in the apartment industry, as they track tenants moving out, seems like in past times they've lost a lot to people buying homes, and they haven't really lost a lot of those people in the last few years. Do you see that could possibly increase and more of these tenants might buy, especially if they see rates rising and home values improving?
It's very possible. I was going to say, interestingly, what you've also seen, especially in the larger cities, you've seen the opposite. You've seen some of the empty nesters saying, gee, I don't need this much house anymore. I'm going to sell the house and I'm going to go live downtown. And so, especially here, we've seen a lot of folks coming back into town and starting to take advantage of the walkability, restaurants, things like that. So you are starting to see that. I think that'll continue as well.
There are so many different downtowns across the country that were unlivable. That is now a very attractive place to live. I just don't see the pendulum swinging back. The city centers are really attractive places to live.
Well, it'll be interesting if I move into apartments. They better like Journey and the Beatles. Well, stay tuned. We'll have more EY Outlook on real estate. Stay with us. The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL. Welcome back to the Commercial Real Estate Show. I'm Michael Ball. We have Mark Grinis and Tom Brown here with us with EY. We're looking at EY's outlook on real estate. And gentlemen, there's certainly been a lot of flow of capital into the U.S. for debt and for equity. And it seems like a lot of different sources. There's some kind of changes going on with some of those sources. Where we see our capital coming in the next couple of years, and how much will be flowing in? Show me the money, right?
I guess there's a couple ways to look at it. I mean, I think that the headlines oftentimes comes of foreign capital source. The bread and butter of capital for real estate clearly are insurance companies, pension funds, endowments. And I think if you can talk about each one, I think the pension funds and endowments is an important class to look at. They're, for the most part, underallocated. How they divide up all of their assets to pay, pension obligations and things in the future, they are underallocated to real estate. That is a significant pool of capital. And so if you step back and say, where were we in 2008? Maybe 50 billion of capital was going into real estate private equity. Today that number has doubled, and it has gradually stair-stepped. And if you look at the returns that are coming in from the vintage funds that were formed over the class, the returns are very attractive, and a lot of the transaction volume is very active. So capital's coming back in, it's getting reinvested and redeployed. And in spite of all the $1.2 trillion of transaction volumes that are taking place, they're still underallocated.
So you expect that to continue?
So I think the capital continues, the transaction volume sustains, and the pensions and endowments will, generally speaking, look to try to up their allocations by 30, 40, 50 basis points.
And these funds and allocations that are in core assets and gateway markets that maybe have some cap rates of 3% and 4%, are these still good deals?
As one of my, if you look at a lot of the big money, they've got to pay pension obligations. There's obligations associated with a lot of that capital, and it has to fund future obligations. If you're having something that generates a 4% return when the 10-year is sub 2, or other sovereign type debt, the Bund, or you look at a lot of different real estate, that 4% yield to you and I says, wow, that's kind of not a lot of headroom there. That still is an attractive yield to fund obligations that they're going to have to make in the future.
And still considered safe somewhat, right?
Absolutely, that's right.
Right. What about debt? How about the banks and CMBS? What do you see moving forward with capital for refinancing or developing new projects?
Yeah, I think the CMBS market has come back fairly healthily. You saw a lot of the refinancings that were done at the first part of the cycle. They're not going to start coming due 16, 17, 18. I think there's going to be fine. You're going to have values that are still up, and you'll see a lot of that roll back over. I think that.
So not the opportunities that some investors hoped that would be there, right, when those 10-year balloons came in.
Yeah, I think that we're still, we talk a lot about the cycle and not just drawing these generalizations, but I still think there's a lot of runway on the cycle for this go-round. I think we'll have to wait and see what happens there. And CMBS is going to continue to be very active as those values stay up there, and people are deploying, their capital. That debt market's going to continue to be fairly frothy.
Yeah, I mean, I guess the only thing I'd add to that is, there's been an incredible amount of focus on the 10-year paper that was issued, at the peak of the last cycle, and that this wall of maturities that's taking place. There's a wall of maturities taking place. There's also a wall of capital to receive it as well. Yeah. So, if you're in a location that was done in 2005 that has no job growth and no activity, and that wall of capital may not be there for you. But for anything other than that, certainly we're seeing plenty of liquidity, to recapitalize it and address those maturities.
And strong fundamentals, like you said, in most markets have really picked up values. What about Fannie and Freddie moving forward? They'll still be flowing money, especially to multifamily.
Yeah, I mean, it's been a tremendous capital source. I guess I continue to say I'm also looking at single family as to see origination start to rise in that space.
Mm-hmm. What about crowdfunding? Have you guys, when you're looking forward at the market, is that a significant piece enough to even get a mention, or is it too small and not really an impact yet?
You hate to discount it because the Ubers and of the world, can completely disrupt a marketplace. That said, there is clearly institutional capital of such order of magnitude that it is filling most of the voids. I'm kind of a wait and see and interested to see for it to really take off.
Well, you guys are bullish, it sounds like, on commercial real estate, on the real estate market.
We're bullish for accountants, okay? I don't know. Maybe we're really bullish for accountants.
Yeah.
I don't know. Maybe that's a sell signal, actually.
There you go.
Right. So how long might the good times last if you look deep into your crystal ball?
Look, I think the 50% of global growth in the last 5 years has been China, and China is slowing, and so that cannot be discounted. China has been the most interesting real estate story that I've followed in my career. They have done what Henry Ford did to automobiles, they have done to cities, and they are cranking them out rapidly. It is a massive economic engine, but it's slowing. That will have some implications to us. Yeah,
and that's interesting because, as you said in your outlook here, real estate has been a big part of China. Well, next we're going to talk about some opportunities, so stay with us. EY on Commercial Real Estate Outlook. Stay with us. We'll be right back. Xceligent, the resource professionals like CCIMs, CBRE, JLL, Colliers, and Bull Realty use for market intelligence. Commercial Search is the site to market and find available properties to buy, sell, or lease all over the country. Visit commercialsearch.com. Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Today we're getting Ernst & Young, EY's outlook on commercial real estate, and we have Tom Brown here with us and Mark Grinis. And gentlemen, what about some takeaways? What about some tips? What about some opportunities? Where are there opportunities moving forward?
Yeah, I guess I would, to make money in real estate, you need strength. You need economic activity and strength. And I think there is, without question, different cities and different parts of the market where there's tax, legislative fact patterns that are business friendly. And oftentimes those business friendly, clearly take Texas and in spite of the oil, is creating job growth. No one likes to fight, having to steal tenants from somebody else because there's no job growth. It's much more easier to do, when there's economic activity. Focus in on those key markets where you're seeing lots of job growth and support there. I guess second, I would probably say interest rates will rise. They will be slower than you think. But the principle of leveraging long is without question still a rock solid expectation. Interest rates will eventually move up. With the job market the way it is, we are ultimately going to start getting some wage inflation that will show up, and it can show up fast. So that's the second thing. Third, if you're really, you have a good propensity for risk, there's a lot of opportunities overseas. Slowing China, Brazil. There are lots of countries that have fundamentals and currencies that make it a very attractive place to investment. I think there will be incredible amounts of money made in certain countries, but not without risk.
Right, not without risk. And there's more in their outlook, and we'll have a link to this outlook on the show website at commercialrealestateshow.com. Well, are there certain sectors or things that might be good ideas? You mentioned industrial.
Well, there are definitely different sectors, as Mark said. Looking at where the market is, where the growth is going to be very important. Understanding where the demographics are going to change and trying to anticipate those is going to be very important. I think if I look at the future and a piece of advice, it's don't get too impatient. There's a lot. It's very easy to underwrite stupidly and start thinking about, we can make this assumption, even if it doesn't come true, surely we can get that underwritten and get that financed. So you don't want to get too ahead of yourself and make stupid investment. And looking at, there's opportunities in different places at different times, and not just being married to that one specific piece.
Yeah.
And then also, if you're going to, I had to put the plug in, always make sure you have a good set of advisors from tax structuring, accounting, reporting,
and brokerage.
It's extremely important because it's very complex. There's regulations all over. Different countries have different regulations, different rules, and navigating those is very complex. So don't try to do it on your own.
I guess I'd close with, you can't overlook the importance of technology. Old crusty real estate guys that just think, I've done it this way, I'll always do it that way. There is too much disruption taking place in the marketplace, and whether you're using technology to use space more efficiently, your back office more efficient, using leverage, how to outsource certain pieces of your business to different service centers, taking all of that in consideration is embracing technology. It'll make your platform more efficient. It'll allow you to focus on your most important resource, your people, and ultimately, it'll generate more profits for you.
Quick question, if you run a business, go long on your leases now or short, generally speaking?
Go long on new leases.
Go long on new leases.
I would agree.
Go long on new leases. Gentlemen, thanks for joining us. We appreciate you being here in Studio One.
Thank you so much for having me.
Appreciate it.
And we appreciate you listening out there on one of the 47 stations, YouTube, iTunes, or the show website. Until next week, be sure that you always lead, learn, and laugh, and join us for the Commercial Real Estate Show. The Commercial Real Estate Show is brought to you by Bull Realty, a great place to do business. Xceligent, information for the professionals. And Commercial Search, properties for sale and lease. To access these companies or for additional videos, podcasts, and articles, visit CREshow.com.